Hey guys, Stock Saturday, and it's another slightly red week for me, underperforming the market a little. Still sort of trying to find a bottom somewhere here, I think. I did slightly worse than the markets, down about 10,000, 2.7%-ish, compared to the markets. Nasdaq up 0.42%. And the S&P up about the same, 0.57%, a little bit better. So yeah, I'm in the red. This is largely on the sort of options side, just things being a little bit quiet. Some other sort of stocks down, as you can see on Friday. Most of mine sort of had a little bit of a small dip, 1%, 2% on Himax, and yeah, they're still looking sort of broadly okay, really. Some of the others that I was buying last week, BlackRock, sort of had a little bit of an up move. It was sort of close on $900, and yeah, Himax sort of coming down a little. That sort of needs some company specific news, really. CME Group doing quite well, up 14.5% on that now, with some sort of reasonable dividends already. But yeah, all sort of looking okay. Euro next as well on the massive Euro stimulus. I'm guessing a fair amount of that will go through the Euro next, all the debt issuance. So yeah, they're doing pretty well, 18%. So yeah, let's have a look at some news. So we had the Fed meeting this week, and a lot of people sort of were wondering if this was going to be a bit of a turning point, with stock markets sort of having a, 10% or more correction, whether the Fed would be a little bit sort of less hawkish than they have been. And yeah, they weren't sort of all that much. They don't want to be seen as political, I suppose. So they've dropped their GDP expectations a reasonable amount, from 2.1% this year to 1.7%. Increased unemployment rate a little, increased inflation, and kept their interest rates expectation the same. So 2/4% cuts this year expected, and they sort of put this down to increasing inflation but lower growth and slightly higher unemployment. They said it balances each other out. They sort of kept the longer run, sort of 2027 and longer run figures almost exactly the same. Inflation is exactly 2% in 2027 and the longer run, which we know that never happens. I guess they're saying that isn't exactly what's going to happen, it's just sort of more a target. And yeah, they're still saying two more cuts in 26. 1.5. Obviously, it's not possible to do 1.5 in that time, but down to 3.25% in 2027 and 3% longer run. I really can't sort of see this playing out, but that's what they're saying. I think if we're sort of getting a fair amount more inflation coming down, then these will probably come lower before long. We've seen Trueflation. If you follow Trueflation, that's sort of down. Did sort of bottom out on the US year over year at about 1.3%, where obviously you're looking at high twos on PCE. Trueflation has come back up to about 1.7%, so still way below this, and we'll see if it sort of feeds through to these numbers. And I always like to look at what each individual member is putting on their sort of dot plot. So these dots are each member of the FOMC, and they've sort of tightened up a little bit. So this is obviously each year. You were sort of getting, I called him Captain Hawk, or Mr. Doomsday possibly, because he was sort of saying at one point like 6% rates, for 2026, and that's obviously, whichever person that is. It could have been one of the ladies, but yeah, they've come all the way down, and they're sort of largely now in a tight 1.5% range for every year, coming down to sort of, as they're saying, 3%, 3.5% maybe longer run interest rates. So they're basically saying we're never going back to 0% unless something extremely drastic happens. So we shouldn't be using that as a bull case. I think a lot of sort of REIT investors and bond investors and people are sort of expecting a recession and we go back to 0% rates again. I just can't really see that. Taking a look at some earnings, we had Broadcom's first quarter fiscal year, so they're sort of not in the calendar years. This is, I believe, November, December, and January, so a little bit out of the calendar, but not too bad. And sort of first company really reporting any time period of this year. And things looking pretty good. They're still sort of digesting the VMware acquisition, so numbers sort of looking a little bit off on GAAP accounting. Proper net income 5.5 billion compared to 1.3 billion last year. That was sort of a lot of acquisition related costs, but yeah, still looking quite good on sort of adjusted net income basis. 7.8 billion compared to 5.2 last year. So very good, with revenue obviously up 25%, partly as a result of that. Just sort of thinking, what is that on a margin basis? Is adjusted net income is 52%. So yeah, not sure whether that will hold. Of course, they were expecting sort of adjusted EBITDA. So yeah, adjusted EBITDA of 10.083 billion. So that would be 14,916. So 67.6% adjusted EBITDA. So they were targeting 60% adjusted EBITDA after the acquisition. So that's really, really solid. Again, I'm guessing AI sort of has been stronger than they were anticipating. And I think they were saying 60 billion in revenue. Or no, it's 50 billion in revenue. Yeah, so again, if you sort of annualize like the 15 billion, almost 15 billion for Q1, you could be potentially looking at 60 billion, even with no growth. So 50 billion expected revenue, we're sort of 20% above that, and 67.5% adjusted EBITDA. So really, really solid. And the diversification happening even more. Last year was 62% semiconductors, 38% software, and it's now 55-45. So getting towards being a 50-50 sort of, semiconductor and SaaS company, which is quite nice. So when I said not that much growth for this year, they're expecting not a lot of growth for the second quarter at least. So that would be, I guess, February, March, and April. We'll see that sort of sometime in early June, I expect. They're saying 14.9 billion, exactly the same as this quarter in revenue, and 66% adjusted EBITDA, so ever so slightly lower than what we've just had. Hopefully that can sort of pick up later in the year, because they are at sort of quite a high earnings multiple at the moment, sort of expecting rather a lot of growth. And yeah, they announced a quarterly dividend of 59 cents. Very, very nice. And just coming down to the balance sheet, when they're sort of deleveraging like this and trying to digest the large acquisition, I like the fact that they don't compare it to this quarter last year. They compare it to just last quarter, so November the 3rd, 2024. So this is comparing, post-acquisition costs, if you like. And yeah, cash is basically exactly the same. I suppose some of these numbers are less likely to change, in just 3 months. So yeah, current assets up slightly, inventories very, very similar. And then obviously the big numbers that have grown as a result of the acquisition. Goodwill at 97 billion. This was sort of, I can't remember, 50 or something before the acquisition, and a huge amount of intangible assets. That's come down 2 billion. I guess they have to sort of sift through what they've actually bought and whether it is going to be useful. Short-term debt up to 5.6 billion. So some of the long-term debt basically has come into current. Long-term debt come down, but overall, you add the two up. Looks like we're down about 1 billion from last quarter. So pretty good. Obviously, I would sort of kind of like that to speed up if possible, but yeah, it's still quite a large amount of debt, sort of 60, 67, 66.5 billion now. But yeah, and other long-term liabilities down 1.2 billion as well. So yeah, not too bad. So overall, they've come down sort of a reasonable amount from their sort of $250 highs. Now we're being at sort of 190, high 180s sort of during the week. Still sort of pricing in a reasonable amount of growth. I think they're at sort of 30 times earnings now, but obviously it's, you know, semiconductors and AI related, which I still think has, you know, fairly long way to go. Whether it's sort of Nvidia doing well or TSMC doing well or whoever, I think there's, you know, still plenty of business. And then obviously on the software side, that's always good margin. Yeah, it was much easier buy back when it was sort of 15, 20 times earnings and just consistently growing. The multiple sort of never really went up. They just stock price grew with their earnings growth, where now it is sort of outstripped a bit. And yeah, I wouldn't be looking to sort of buy at 20, you know, high 20s, 30 plus times earnings. But I'll happily sort of hold them and see where the sort of AI run goes. We know TSMC have announced their results, sort of pretty good for February. So we'll see what comes of March as well, and presumably we've still got plenty of runway for this. So a quick look at CF Industries, the part of my sort of agriculture and foods related stocks, and yeah, it's maybe an area that I don't know as well as I was sort of hoping. I sort of had a fairly large loss on my FMC so far. We'll have to see where that goes, but yeah, CF Industries not doing too bad. I think I'm sort of where am I? Well, this doesn't show the FX position, but yeah, 8.27% down. I think it's about a couple of percent down, including the FX side. But yeah, they're still sort of looking okay. World's largest ammonia producer. That was sort of part of the draw. They can use it for sort of green energy potential as well. So a lot more of that. And so looking at these results, obviously this is a little bit out of date now. This is sort of one of the last earnings results that I'm looking at. So yeah, we're still looking at October, November and December last year. But yeah, they don't sort of move drastically. Revenue slightly down, and then all the sort of profits reasonably up. Looks like they've been doing a fair amount of cost cutting, so that's quite helpful, of course. Yeah, adjusted EBITDA is slightly down, but normal EBITDA is up. So yeah, you can sort of come down to their reconciliation, which I'll have a check on. Yeah, I suppose as this is a commodity-based business, they are sort of at the mercy of the market for their input costs. So sort of cost of natural gas used for production is down quite a bit, and then natural gas costs in cost of sales down a reasonable amount as well. So I'm guessing that is part of the increased profit. Also looks like they've been doing quite a bit of buybacks as well. Weighted average common shares outstanding down from 190 million, it looks like, down to 173.5 million. So yeah, quite a lot. Oh yeah, and the adjusted EBITDA was due to employee benefits policy change, so nothing huge in that. Yeah, figures haven't really sort of changed all that much, to be honest. Adjusted EBITDA for the year, 2.2 billion. They sort of do a lot of comparisons to the competition. Mosaic sort of 2.2 billion in adjusted EBITDA. Nutrien 5.3 billion. They're a much larger company. And Yara 2 billion. So yeah, a few of them sort of make similar amounts of profit, and they're sort of highlighting that they convert more of their adjusted EBITDA to free cash flow. This could be a sort of, you know, a one-off event. You know, I can't imagine these figures stay where they are Longer term, you know, they just, in these presentations, I do prefer looking at the presentations rather than just like the SEC hard numbers for the video at least. It's just, you know, something a bit more visual to show. Yeah, a lot of companies do sort of tend to spend a lot of these presentation slides sort of bigging themselves up a little bit. Oh yeah, they did show the competition's market cap. So Yara are actually a much smaller company, and they do sort of around the similar adjusted EBITDA. So, you know, potentially a little bit better value there. Nutrien do a lot more, but they're a bigger company. Again, 22 billion. You could say sort of slightly better value on adjusted EBITDA. And Mosaic do half they're half the market cap and do a similar adjusted EBITDA, but it doesn't all get flow to free cash flow, converted to free cash flow, if you like. So, yeah, it's an interesting slide. They are saying they expect nitrogen to be doing pretty well. There's an enormous shortfall for sort of 25 to 29, so either an awful lot more supply comes on. They're saying 8 additional world-scale facilities to meet demand growth. And, yeah, not sure whether China are doing anything. They're putting this demand and supply growth excluding China. But, yeah, either sort of price goes up to incentivize more, or we just have less and need to find an alternative, essentially. But, yeah, that's always good. So just coming to a bit of economic news, aside from the FOMC, of course, we've had the GDP now sort of coming down. This was 2.8%, minus 2.8% at one point. It's now come down to minus 2.1. Obviously, some of this is still imports, which sort of distorts the figure. Front-running tariffs, you get an awful lot of imports, and that drags down GDP. I think a lot of people are sort of looking at this and saying, look, it's recession. We've got a large quarter of negative GDP, but you could have a sort of significantly positive Q2 potentially. And, you know, people will sort of not really realise those two were linked. Yeah, you had sort of retail sales for February in the US, looking slightly weaker than expected, but a bit stronger than last month. And housing looking a little bit better than expected. GDP now come a little bit more positive. EU CPI sort of still looking okay. A little bit worse than, well, they say worse, lower than expected. That's better, really. And then, yeah, for FOMC. And we got some UK news, not exactly great, sort of average earnings, 5.8% still, you know, hinting at inflation. Claimants, unemployment sort of up a little bit, or unemployment claims up a little bit, but employment up a little bit, so sort of cancel each other out, I suppose, paradoxically. Unemployment still 4.4%. We didn't cut interest rates. Don't think anybody thought we were going to, but they were 8-1 in favour of holding instead of the 7-2 expected, as if that sort of really means too much. Job numbers in the US looked pretty good, but the UK deficit not looking good at all. The previous month was revised up slightly, so we borrowed 2 billion less than we thought last month, but 3.7 billion more in February. So yeah, I think this was they totaled it up cumulative. We're looking at about 120 billion plus deficit for the year. So ever more printing. And looking at the portfolio, as I say, crypto and gold miners not doing all that well, despite sort of gold breaking $3,000 an ounce, which was a little bit of a surprise. I thought we might have that might have been a little bit tough at a break, unless we sort of go down below it. But yeah, the gold miners don't sort of really seem to believe in the move, even though they presumably results will start to look much better very soon. Crypto, on the other hand, needs price to go up rather soon, I would say. But yeah, sort of Fresnillo doing pretty well, £9.18. So really happy with that. And Interactive Brokers side, pretty much unchanged entirely. And on the option side, sort of had a few knocks. High max obviously coming down a reasonable amount. The options get hit even harder, but it's still obviously well in the green. And I've sort of taken out I think 3 times my original investment from that. So yeah, that's obviously not shown here. But yeah, Coeur Mining sort of up slightly, Equinox quite a bit down. These sort of they don't always move 1-to-1 with the share price. So yeah, you get some erratic moves, and the the stock might go down a little, and the profit looks quite a bit different. But yeah, that's just options and low liquidity options, especially. I did buy a little bit of Hive, not a huge amount, and it doesn't make a lot of difference. That's still sort of heavily in the red. But I bought quite a lot of iron. I think I was at 100 contracts last week, and I bought 100 contracts. They're looking sort of fairly cheap. Could do with an announcement of an AI deal with someone similar to Riot, really. But iron sort of have the low cost of production and increasing production over the next few months to sort of potentially look forward to, and they're the most efficient fleet out there. So I do like what I'm seeing with iron, and this is sort of a hell of a risk. It's January next year expiry. But if we see a sort of decent crypto bull run, I think they could do really well. I did sell my Fortuna mining because they don't seem like they're doing a huge amount of anything, and these were January options. They're sort of comparing, how much they're producing for their market cap to someone like Equinox. They seemed worse value. They got rid of all of their silver now, so hence the name changed to Fortuna Mining from Fortuna Silver Mines. So yeah, just didn't really like what I was seeing. They had a little bit of a pump up. I think I was sort of 60% down. It come back to 50% down, and I thought that money would be better used elsewhere. And I get a little bit of a tax loss harvesting off that as well. But yeah, that's not really the reason. So £3 of cash left. I do have about another 5 potentially to put into this. Yeah, obviously it's not looking great at the moment. 17,000 down on what I've currently got, but there's some realised profit not included in that, of course. So yeah, could do with some decent moves on the crypto miners and the gold miners, but we'll see. So leave your thoughts in comments below, and like and subscribe. See you soon.